Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 31. An investor has two portfolios known to be minimum variance set for a population of three securities A, B and C having below mentioned weights. And the weights of portfolio X and Y are given. It is supposed that there are no restriction on short sales. So let's analyze this. What does the question signifies? Minimum variance set means the proportion which they are given for the respective portfolios. They are already in an optimal position in terms of risk. So minimum is the lesser one and the variance is nothing but the risk. So less risk set or less risk portfolio. So this proportion, this portfolio weights will give us the less risk portfolio for the any return. That is what assumed here. And of the three securities, let's say the securities they are mentioning as A, B and C. For these three securities, if we buy in this proportion 30% for 30% of A, 40% of B and 30% of C, will give us the lesser riskier portfolio, or it will reduce the portfolio and make use of diversification at the optimum level. That's what this minimum variance set signifies. Now they have given assumption that there are no restriction on short sales. Why this they have given? This is because if we are arriving at a uh, minimum variance set, we use arithmetic calculations and logical arithmetic calculations, wherein how we use in simultaneous equation method or binomial method, trinomial methods and all, wherein we'll find the value of x and y, right, to match to the linear equation. So the same way, when we are calculating, there might be possibilities that either one or two weights will go negative to achieve the minimum variance or the linear equation. So in that case, in derivative also we might have studied that we can short sales, right, wherein if you don't have that security but still you can sell by using the derivative market. So that's where this short sales comes in. So for using the negative weights, the short sales assumption is given. So this assumption lets us use negative weights for any combination that brings the minimum variance. So this is what the question signifies. Now we'll go to the requirements of the question. What would be the weight for each stock for a portfolio constructed by investing 5,000 in portfolio X and 3,000 in portfolio Y? Now they have given some amount to be invested in these portfolios and they are asking us the weight for each stock. So here stock signifies A, B and C. What will be the weight of these securities if we invest 5,000 in portfolio and 3,000 in portfolio Y? So for that we can directly multiply with this uh, weights of the portfolio and total those values to arrive at the um, answer. We'll see the answer directly. Investment committed to each security would be portfolio X. So this 1500 is nothing but 5000 multiplied by 0.3. Then 2000 is nothing but 5000 multiplied by 0.4. Then 1500 is nothing but 5000 multiplied by 0.3. So totaling up to 5000 in the first case, and in the second case it is 3000 as they have told for portfolio Y. So this 3000 multiplied by 0.2 600, then 3000 multiplied by 0.5 1500, then 3000 multiplied by 0.3 900. So total if we see it is 8000, and individually 5000 and 3000 for portfolio X and Y in the minimum variance set proportion they've given. Now the stock weights would be 2100, 3500, 2500. This will be the combined weights for the combined portfolio. So this 0.26 is nothing but 2100 divided by 8000. So this will give us 0.2625 weight of stock A in this combined portfolio minimum variance set. And 3500 divided by 8000 will give us 0.4375, which is 0.44, which is for the security B, stock B. And 2400 divided by 8000 will be 0.3. So these are the weights. Weights for each stock for a portfolio constructed using the minimum variance set. Now the second requirement is, suppose the investor invests 4000 out of 8000 in security A. How he will allocate the balance between security B and C to ensure that his portfolio is on minimum variance set. Now we in the previous requirement we have just invested in the proportion of already defined minimum variance set. So the question only gives us two weights of minimum variance set, wherein we just invested in that amount and then we got a weight of stocks, right? But in the second requirement they are just changing the weights. So what they are telling us, we will be investing 4000 out of 8000, so which will be 50 percentage. So the weight changes here. They are asking, if the weight is 0.5 in case of weight A, what will be the weights in case of B and in case of C, and in terms of rupees. So the balance 4000 we will be allocating in one ratio for security B and C. They are asking what would be that ratio. We can't just directly take let's say here in this ratio, so we can take some ratios. It will not work that way, because minimum variance set is arrived by a linear equation. So whatever ratios you are whatever weights they have already found out aligns to that same linear equation. So to find out a new weights, keeping one weight as a base, let's say keeping one weight as fixed one and finding out the other weights, we need to apply in the same equation. So for that we can follow this linear critical line, or the linear equation method, or uh, let's say straight line equation, anything we can say. So it is nothing but y equal to mx plus c. That is the commonly used formula in case of mathematics and statistics. So wherein the same thing they have given it in a different format. So weight of B equal to A plus B into weight of A. Here A will be the intercept and B will be the slope. So let's not dive deep into technicality of the mathematical logic, but we'll just see what this is. So it's nothing but, since we have three weights, we will be just taking two weights equation. So the minimum variance or the minimum variance set they have given for three weights, we will be concentrating of only two weights in which these weights are placed in the equation. So we are deriving an equation and then we will be substituting the values of portfolio X and derive one equation, and then portfolio Y values and derive one equation for just two items. Then we can reverse work to get the value of 1, like a simultaneous equation method. So substituting in this critical line or simple say straight line equation, we are substituting only weight of A and B. Why? Because we know the weight of A, right? So we can directly find out the weight of B. Now 0.4 equal to A plus 0.3. So weight of B equal to A plus point B. This is equation 1. And um, yeah, portfolio y, this we are applying it and then arriving at the second equation. Now solving this equation, we are getting the value as a equal to 0.7 and then b equal to -1. Now applying it in any of one of these equations, we will get that weight of b equal to 0.7 minus weight of a. Now since we already know that we have to keep the weight of a at 0.5, so weight of b will be equal to 0.7 minus 0.5, which will be 0.2. And we already know that these all are in a minimum variance set, and in this portfolio only 3 securities are there, so ultimately the sum of these 3 securities weight should be equal to 1, right? So we know that weight of a is 0.5 and weight of b is 0.2, so the balance will be 0.3, which is nothing but weight of c. That's what they have considered here. So 0.3. Now allocating these weights, so this is for b and this is for c. So we know that here 4000 for uh, a 50 percentage, then 20 percentage will be for b, which is nothing but 1600, and then 30 percentage for c, which is nothing but 2400. Same there given here, thereby achieving the minimum variance also. So here it's like the second requirement gives us a new ratios which achieves a minimum variance set. So that's nothing but 0.5, 0.2, 0.3. We can add up to this table. That will be the new variance set based on the previous linear equation. Thank you.